Chief U.S. Equity Strategist and Chief Investment Officer at Morgan Stanley, and Morgan Stanley adding 3 stocks to their fresh money buy list. Can you explain kind of what the thinking was behind adding these 3? It was AbbVie, Northrop Grumman, and Public Service Enterprise Group. You guys are hunting for value, it feels like. Well,
we're hunting for defensiveness, right? So obviously one's a defense company, one's a utility, and one's a pharmaceutical company, and they're all in a pretty good uptrend right now. The technicals look pretty good. And we think this is what you should be gravitating towards. We've had some of a defensive posture really since May when we felt growth was peaking. That has worked. We're just sort of doubling down on that same view. And as you know, we tend to go sort of against the grain. We don't necessarily go with the momentum. This would be definitely an out of consensus sort of view at the moment. It's starting. We think there's more to go in the defensive rotation.
Do we not? If we see Fed cuts, I always think about how long it's going to take for them to work their way into the economy, but the market is instantly going to start to buy maybe mid caps, small caps, maybe the Russell 2000?
No. I mean, we've been very consistent. I mean, it could, yes, of course, but our view is that's not what you should be doing. We saw, once again, people tried to do that trade in July. It didn't work out so well. Now, we think that was more about a degrossing, okay? So as people rotated out of the winners, they were probably covering some of their shorts in these areas that they were underweight, and that really is what drove that. And now we have a very kind of negative technical pattern where it looks like that was a one-hit wonder. And historically, when the Fed cuts interest rates, small cap, mid caps do not outperform. Now, the market can go up, but typically small mid caps still underperform, even if it's a mid-cycle slowdown. That's what the data shows. So I just think people either don't understand that history, they're just eager to do something different. That's not the trade. We think the trade is to stay up the quality curve and skew more defensive than growth oriented, because rates coming down will be most beneficial for that cohort.
And the point has been made that you take a look at some of the small cap indexes, such as the Russell 2000, it's a bit junkier than it has been in the past. I have to imagine some of that is that you aren't seeing those smaller companies IPO, those high quality small companies actually tap the public markets.
It's a very good point. I mean, the thing that's really been missing is we haven't seen a lot of equity issuance, and we know there's supply out there. There are companies that probably want to go public. There's probably companies that want to raise equity capital because their balance sheets are a little sloppy, and it just hasn't happened. And I think the reason why is there's not a strong bid for that. I mean, we've seen that all year. Once again, the Russell 2000 is basically flat on the year. The equal weighted Russell's down on the year. The equal weighted S&P is still underperforming the overall S&P. So the breadth of the market continues to be soft, and that just continues to speak to this idea that we're late cycle. It's not mid cycle. Fed cutting usually makes the market narrower, not broader.
Well, just to follow up quickly on that point, like you said, there hasn't been that consistent bid. Does the logic then follow, if we did see a consistent bid for some of those smaller companies, that IPOs actually would pick up here?
It could, absolutely. I mean, we're open-minded, as always, to anything. If we were to see in September, for example, a very broad rally like in July that looked a little healthier, meaning in an up market, not a down market, not a degrossing, then we would have to revisit our view on that. Something else would be going on that would suggest that, hey, maybe the Fed is not only going to cut rates, but it's going to have a meaningful impact, and it's going to help these companies. The other thing you brought up a good point is the Russell 2000 is really a lower quality version of small caps. So I want to make it clear, like, we don't hate all small cap companies. I mean, that's silly. The S&P 600 is a higher quality version of that. And so as you hunt for small mid-cap stocks, and I would advise doing that, just, once again, stay up the quality curve. You don't have to go down to the junk pile.
I really feel the need to go back to something we were talking about before. You sat down, we said, okay, Mike Wilson can take his victory lap. We saw that 10% correction, nearly 10% that you were thinking of. You saw it earlier than we expected. What does this mean? Does this correction have further to go?
Well, it's still the third quarter, okay? And once again, the seasonals right now are just not particularly great. So as I said at the beginning, I think we're going to stay in this range. I find it hard to believe we're going to break out back towards the highs. I also don't think we're going to completely break down in a way that would argue that we're entering a new bear market, okay? But the lower end of the range is, to me, the magnet now, because that's where the valuation support really lies. 19 times is closer to the low end of that range.
You said you're focused on jobless claims. I talked to Ed Hyman on Sunday from ISI. He said the same thing. If we get a labor market that really weakens, and the SOM rule's already been triggered, but if we get, for example, I think September 6th, we get non-farm payrolls, and if we get another jump up in unemployment to 4.6%, do you think we see more mayhem in the markets?
Yes. I mean, a 4.6 would be pretty definitive. Now, just to be clear, our economics house call is still we're in a soft landing outcome. What I would suggest, though, is that the market is priced for that, right? The market is priced for a soft, actually even better than a soft landing outcome. It's priced for a reacceleration. So just kind of putting a little risk back into the market that maybe the hard landing is no longer 0, but it's 20 or 30% again, that once again just argues that multiples will probably bleed lower into September, even if the jobs data is kind of stable. Because at the end of the day, the jobs market is weakening. And so how could you sit here and say that the risk of a recession is 0, which is kind of what's priced in the equity market? And one last thing, the bond market is definitely pricing a higher risk of a hard landing. I mean, that's what the yield curve is telling you. That's what the 2-year yield versus the Fed funds is telling you.
Does that divergence worry you as an equity?
Well, I'm just saying as an equity person, you should pay attention. I mean, the bond market has probably a better look at, okay, what is the risk here? The bond market is not saying recession, to be clear. It's saying the risk of a recession has gone up in the last 2 months, which makes sense given what you just said.